What are the repercussions of a portfolio loss and how to overcome them? Financial expert Ms. Amrita will explain this now.
The repercussions are that when we face losses in our portfolio, we panic. There is panic and there is panic selling. We want to get out of that asset class. Again, a knee jerk reaction, again, coming from our primal brain. We don't want to stay invested for long term. It could be that the product that you have stayed invested is a quality product and the entire market has corrected. That is why the product is showing negativity. But if the underlying stocks are very good, then it would recoup back the losses. And if you stay longer, like Sensex or Nifty, if you've seen the long-term chart, in the short term, there could be so many reasons for fluctuations. But over a period of time, it has actually doubled money. So there are a lot of research reports which says that over a period of 7 years or 10 years, the probability of making money is almost 95% of time. The probability of doubling your money is actually 72% of times. But then the product has to be good and we have to keep ourselves calm and rather than having a panic reaction. But the repercussion is panic selling, hurriedly switching out of equities or into those asset classes that are facing volatility. Hurriedly, you want to switch, so be it. If it is a stock, like if you would have invested in Kingfisher stock and the Kingfisher stock just fell left, right, and center and became a penny stock, it makes sense to get out of that stock because intrinsically it is not a quality stock. But if you are into a portfolio that has quite a good names, it's got very good characteristics, it's shown consistency of return, then hurriedly switching out of it may not make sense. Halting your systematic investment plans. It is like your good EMI. There are a lot of EMIs we pay, but this is like a very good EMI, which means you are in a recurring fashion saving money, and that money is getting into a particular asset class, say like equity, which actually is a wealth compounder. And stopping it means that maybe, during retirement, you may not have enough funds to take care of your retirement expenses because the biggest threat today is not terrorism. Though we might get influenced by what's happening in the Middle Eastern region, the biggest threat today is we outliving our own money. We are going to stay longer, but we are going to retire early. And then if our life expectancy is going to be 80, 90 years and we retire at 55, what are we going to do for the next 35 years? Is our funds enough to take care of savings, enough to take care of all our post-retirement expenses? So halting a SIP means our post-retirement expenses are getting, or our retirement journey is getting affected. Refraining from investing incremental amounts in equities, being hyper focused. Sometimes what we do is that overall the portfolio has given a 12% return, but some one or two funds have given minus 5% return. Your focus is towards that negative and not towards the overall positive. Well, you should ask why the negative return happened, but being hyper focused into it is only giving you sleepless nights if the products are of good quality.
Thanks for your detailed explanation. Are you in search of a personal guide who can remove the stress of handling your finances? Then please feel free to avail our expert consultation. And also you can attend our webinars to gain investment related insights. Both the consultation and webinar are absolutely free and you can find the link in the below description. Please like and share and do subscribe to Holistic Investment.